On August 15, 1971, President Richard Nixon closed the gold window. The United States severed the final link between the dollar and physical metal, ending the Bretton Woods system that had governed global finance since the Second World War. What followed was not chaos, but something more subtle and more dangerous. The world entered an era where currency became purely a matter of trust, where central banks could expand money supplies without the constraint of physical reserves, and where the illusion of infinite liquidity replaced the discipline of scarcity. That transformation did not announce itself with violence or collapse. It arrived quietly, embedded in the structure of modern banking, and it created a system that would eventually devour itself. The mechanism at work is simple but rarely discussed. When money is no longer anchored to a physical asset, the system depends entirely on the credibility of institutions that issue it. Banks become custodians of confidence rather than custodians of wealth. They hold promises, not metal. They settle accounts with ledger entries, not deliveries. This works perfectly well until someone demands the actual asset. History shows that when enough participants simultaneously demand physical settlement, the entire structure reveals itself as fundamentally hollow. The gold standard collapsed in 1933 when Americans rushed to convert dollars into gold. The London gold pool collapsed in 1968 when European central banks demanded physical delivery from American vaults. Each time, the system adapted by removing another layer of physical accountability. Each time, the authorities promised that the new arrangement would be more stable, more modern, more sophisticated. Each time, the underlying vulnerability simply moved deeper into the infrastructure. The pattern repeats because the incentives never change. Institutions that control the supply of money will always prefer flexibility over constraint. They will argue that rigid systems create unnecessary hardship, that modern economies require dynamic management, that physical limitations are relics of a primitive age. These arguments are not dishonest. They reflect a genuine belief that human institutions have evolved beyond the need for tangible discipline. But history does not support this belief. The Roman Empire debased its currency gradually over 2 centuries, replacing silver with base metal until the denarius became worthless. The assignats of revolutionary France collapsed within 5 years, despite being backed by confiscated church lands. The Weimar Republic destroyed its currency in less than 2 years through unchecked monetary expansion. Each regime believed it had discovered a new principle that would exempt it from the laws that destroyed its predecessors. Each regime was wrong. What makes the current situation distinct is not the mechanism but the scale. The global financial system operates on a level of abstraction that has never existed before. Derivatives markets measure in the hundreds of trillions. Central bank balance sheets have expanded by factors of 10. Debt levels in major economies exceed any peacetime precedent. And beneath all of this complexity sits a physical market for precious metals that remains shockingly small. The entire annual production of silver is less than $30 billion. The registered inventory available for delivery on major exchanges represents a fraction of the outstanding paper claims. This disparity creates a structural fragility that most participants ignore because it has never been tested at scale. The system works until it does not, and the transition from equilibrium to crisis happens faster than institutions can respond. The mechanics of this transition are already visible. On January 2, 2025, the Chicago Mercantile Exchange processed delivery requests for over 17 million ounces of silver in a span of 48 hours. This represented roughly 2% of global annual production moved in 2 days. The transaction was not a commercial hedge or an industrial purchase. It was a demand for physical settlement by entities that already held massive inventories. Deutsche Bank delivered over 3 million ounces to JP Morgan and Citigroup. These institutions were not buying silver because they needed it for manufacturing. They were securing physical assets because they understood something that most market participants had not yet recognized. The registered inventory on the exchange had fallen to 39 million ounces. At the rate of depletion observed in early January, the available supply would be exhausted in less than 2 weeks. This event occurred against the backdrop of a policy shift in China that fundamentally altered the global supply structure. In late December, Chinese authorities implemented export restrictions that limited silver shipments to 44 licensed firms. The regulation effectively closed the arbitrage channel that had previously allowed Western buyers to source metal from Chinese refineries. The timing was not coincidental. China produces over half of the world's refined silver as a byproduct of its base metal mining operations. By restricting exports, Beijing ensured that domestic industrial demand would be met first, leaving foreign markets to compete for a shrinking pool of available metal. The Western banking system responded immediately. Rather than waiting for inventories to tighten gradually, major institutions initiated a coordinated drawdown of exchange stocks, securing physical possession before the full impact of the Chinese restrictions became apparent. The behavior of J.P. Morgan in this sequence reveals the underlying logic of the system. For over a decade, the bank held concentrated short positions in silver futures, a strategy that benefited from suppressing price volatility and maintaining orderly markets. But a short position in a futures market is a promise to deliver physical metal if called upon. When the supply structure changes, when the sources of replacement inventory dry up, the institution holding the short position faces a choice. It can continue to hold paper liabilities in a tightening market, or it can reverse course and secure physical assets. J.P. Morgan chose the latter. By standing for delivery and draining registered stocks, the bank effectively converted from a net short position to a net long position in physical metal. This was not a trading decision. It was a recognition that the rules governing the market had changed and that possession of physical assets would matter more than control of paper contracts. The historical precedent for this kind of institutional reversal is well documented. In the years leading up to the collapse of the Bretton Woods system, central banks that had previously supported the dollar began quietly converting their reserves into gold. France under Charles de Gaulle was the most aggressive, demanding physical delivery of gold in exchange for dollar holdings throughout the 1960s. The French government understood that the United States had issued far more dollar liabilities than it could back with physical gold reserves. By demanding settlement, France forced the underlying imbalance into the open. Other nations followed. Germany, Switzerland, and the Netherlands all began reducing dollar holdings and increasing gold reserves. The United States initially tried to maintain the fiction of convertibility by delivering gold from Fort Knox, but the mathematics were unsustainable. By 1971, American gold reserves had fallen from over 20,000 metric tons in 1950 to less than 9,000 tons. Nixon closed the gold window, not because he wanted to abandon the gold standard, but because continuing to honor conversion requests would have emptied the vault entirely. The current situation in the silver market follows the same trajectory. The registered inventory at the CME represents the modern equivalent of Fort Knox. It is the stockpile that backs the paper claims traded on the exchange. For years, this inventory appeared adequate because most contracts settled in cash rather than metal. Participants were content to speculate on price movements without ever demanding delivery. But when a significant fraction of the market simultaneously demands physical settlement, the inadequacy of the stockpile becomes undeniable. The exchange reported that registered silver inventories fell by 2.8 million ounces in a single day during the first week of January. This drawdown occurred while the total open interest in silver futures remained near historic highs. The ratio of paper claims to physical inventory reached levels that would be unsustainable if even a small percentage of contract holders demanded delivery. The consequences of this imbalance extend far beyond the wholesale banking sector. Retail dealers in the United States reported inventory shortages within days of the exchange drawdown. SD Bullion, one of the largest online dealers, listed American Silver Eagles as out of stock with delivery estimates extending into March. Kitco removed pricing entirely from certain products, refusing even to accept back orders. APMEX, typically the dealer of last resort due to higher premiums, listed single ounces at $89, while the exchange spot price remained near $71. This $18 premium represented a 25% markup, not due to dealer greed, but due to replacement cost. When wholesale suppliers cannot source metal at the official price, retail dealers must price in the scarcity that has already occurred at the institutional level. The bifurcation between paper prices and physical prices is not a temporary anomaly. It is a symptom of a market structure that has diverged from the physical reality it claims to represent. The phenomenon of backwardation provides further evidence of this structural breakdown. In a normal commodity market, futures prices trade at a premium to spot prices. This premium reflects storage costs, insurance, and the time value of money. When futures prices fall below spot prices, the market is said to be in backwardation. This condition indicates that immediate physical delivery is more valuable than a promise of future delivery. Backwardation occasionally occurs in commodity markets due to temporary supply disruptions, but it typically resolves quickly as producers increase output or inventories are released. In the silver market, backwardation has persisted and deepened, suggesting that the shortage is not temporary and that additional supply cannot be brought to market quickly enough to resolve the imbalance. The Shanghai Futures Exchange reported a drawdown of 46 metric tons in a single session following the implementation of the export restrictions. This represented approximately 1.5 million ounces removed from visible stockpiles in one day. Combined with the depletion observed in New York, the global markets were consuming roughly 4.5 million ounces per day, while global mining production averages only 2 million ounces per day. The mathematics of this imbalance are straightforward. A system that consumes more than twice what it produces cannot sustain itself. The buffer inventories that previously absorbed these mismatches have been depleted. The exchanges that facilitated price discovery now face the possibility of being unable to fulfill delivery obligations. This situation did not emerge suddenly. It developed over decades as financial markets became increasingly detached from physical constraints. The expansion of derivatives allowed participants to gain exposure to commodities without ever touching the underlying assets. The growth of exchange-traded funds created synthetic demand that was met with paper shares rather than metal. The rise of algorithmic trading introduced participants who had no interest in physical settlement and who viewed futures contracts purely as vehicles for speculation. Each of these developments contributed to a market structure where the volume of paper claims vastly exceeded the available physical inventory. The system functioned smoothly as long as most participants were content to settle in cash rather than metal. But when a sufficiently large group demands physical delivery, the entire edifice reveals its fundamental instability. The historical precedents for this kind of breakdown are numerous and consistent. In 1980, the Hunt brothers attempted to corner the silver market by accumulating futures contracts and demanding delivery. The exchange responded by changing margin requirements and position limits, effectively preventing the Hunts from taking delivery and forcing them into bankruptcy. The mechanics were different, but the principle was identical. When physical demand threatened to expose the inadequacy of available supply, the system altered the rules to prevent settlement. The difference today is that the entities demanding delivery are not rogue speculators, but systemically important financial institutions. The exchange cannot simply change the rules to prevent JP Morgan from taking possession of metal without undermining confidence in the entire settlement mechanism. This creates a paradox. If the exchange allows deliveries to continue, it will exhaust its registered inventory within days. If it alters the contract terms to prevent delivery, it will destroy the credibility of the futures market as a vehicle for price discovery and hedging. The inevitability of this outcome has been visible for years to those who studied the inventory data and understood the supply dynamics. But institutions operate on incentives, not foresight. As long as the system appeared stable, there was no advantage to being the first to demand physical settlement. The advantage came from waiting until others panicked and then moving decisively. This is precisely what occurred in early January. The Chinese export restrictions created a visible inflection point, a moment when the supply structure shifted in a way that could not be ignored. The institutions that recognized this shift first secured their positions. Those that hesitated will find themselves exposed to a market where physical metal trades at a significant premium to paper contracts, if it can be obtained at all. The broader implications of this divergence extend to the monetary system itself. Silver and gold have served as money for thousands of years, precisely because they possess qualities that fiat currency lacks. They cannot be printed into existence by central banks. They cannot be debased through political decisions. Their supply is constrained by geological realities and the economics of mining. When the price of these metals begins to diverge sharply from the cost of production, when premiums for physical delivery surge above spot prices, when inventories drain despite rising prices, the market is sending a signal about the credibility of the alternative. That alternative is a monetary system built entirely on trust in institutions that have demonstrated repeatedly throughout history that they will prioritize short-term stability over long-term sustainability. The response of central banks to previous crises illustrates this pattern. In 2008, when the global financial system faced collapse due to excessive leverage and inadequate capital reserves, central banks did not allow the system to cleanse itself through bankruptcy and restructuring. They intervened with unprecedented monetary expansion, purchasing trillions of dollars in government bonds and mortgage-backed securities. This intervention prevented an immediate crisis, but did not address the underlying imbalances. Instead, it encouraged additional leverage by signaling that losses would be socialized while profits remained private. The result was a system that emerged from the crisis larger, more complex, and more fragile than before. The same pattern repeated in 2020 when pandemic lockdowns threatened economic collapse. Central banks again expanded their balance sheets by trillions, and governments issued debt on a scale previously seen only during major wars. The immediate crisis was contained, but the long-term consequences of this expansion are now manifesting in persistent inflation, currency debasement, and a growing skepticism about the sustainability of debt levels that can never be repaid through conventional means. The precious metals markets exist as a pressure valve for this skepticism. When confidence in fiat currency erodes, when inflation exceeds official targets, when debt levels become visibly unsustainable, capital flows into physical assets that cannot be devalued by monetary policy. This flow typically begins slowly, concentrated among investors who study monetary history and understand the dynamics of currency crises. But it can accelerate rapidly when a catalyzing event makes the vulnerability visible to a broader audience. The Chinese export restrictions represent such an event. By closing the arbitrage channel between East and West, Beijing forced Western markets to confront the reality that the available supply of physical silver is far smaller than the volume of paper claims suggests. The institutions that recognize this reality first moved to secure physical possession before the broader market understood the implications. The retail supply chain breakdown provides evidence that this understanding is spreading beyond the institutional sector. When dealers refuse to accept orders, when premiums surge to 25% above spot prices, when delivery times extend from days to months, the divergence between paper and physical markets becomes visible to ordinary investors. This visibility creates a feedback loop. As more participants recognize that physical metal is unavailable at quoted prices, more participants attempt to secure what remains, further depleting inventories and widening premiums. The dealers pricing silver at $89 are not speculating. They are pricing in the reality that replacement inventory cannot be sourced at $71. The market is discovering in real time that the price on the screen does not represent the price required to obtain the actual asset. This discovery process has occurred before in other markets and other eras. In 1979, gold traded at $200 per ounce at the start of the year. By January 1980, it had reached $850. This increase was not driven by changes in industrial demand or mining supply. It was driven by a loss of confidence in the dollar and a rush to convert paper assets into physical metal. The circumstances today are different in detail but similar in structure. The global monetary system is built on far more debt than existed in 1980. Central bank balance sheets are larger relative to GDP. The supply of physical precious metals relative to the volume of financial assets is smaller, and the mechanisms that previously allowed arbitrage between different markets and different regions are being systematically closed by regulatory changes and geopolitical tensions. The Chinese export restrictions are not an isolated policy decision. They represent part of a broader pattern, in which major economies are prioritizing control over critical resources and reducing dependence on international supply chains. This pattern accelerated during the pandemic and has continued through subsequent geopolitical conflicts. The result is a world that is fragmenting into regional blocs, each seeking to secure supplies of strategic materials within its own sphere of influence. Silver occupies a unique position in this fragmentation because it is both a monetary metal and an industrial input, critical to technologies that every major economy considers strategic. Solar panels, electric vehicles, electronics, and military applications all require silver in quantities that cannot easily be substituted. When a country that produces over half of global refined silver restricts exports, it forces importing nations to either develop alternative sources or compete for a shrinking pool of available supply. The timeline for resolving this imbalance is measured in years, not weeks. Building new refining capacity requires capital investment and regulatory approvals that take time. Expanding mine production faces geological constraints and environmental regulations that limit how quickly output can increase. Recycling provides some additional supply but cannot offset a deficit of millions of ounces per day. In the interim, the market must clear through price adjustment. The paper price must rise to a level that either reduces industrial demand or incentivizes enough additional supply to restore balance. But this adjustment cannot occur smoothly when the market structure itself is built on the assumption that physical delivery will remain the exception rather than the rule. The exchanges face a choice that has no good outcome. They can continue to honor delivery requests until registered inventories are exhausted, at which point they will default on contracts and destroy confidence in the futures market. Or they can change the contract terms to limit physical settlement, which will also destroy confidence, but in a different way. History suggests they will choose the latter. When the London gold pool faced depletion of its reserves in 1968, the response was to create a two-tier gold market with different prices for official and private transactions. When the Hunt brothers threatened to drain exchange inventories in 1980, the response was to change margin requirements and position limits. The pattern is consistent. When physical demand threatens to expose the inadequacy of supply, the system changes the rules rather than allowing the market to clear. But each time the rules change, confidence in the system erodes. Each intervention proves that the paper claims are not actually backed by physical metal in the quantities promised. The inevitability of this erosion does not mean the timeline is certain. Systems can persist in unstable equilibrium for longer than rational analysis would suggest. The disconnect between paper and physical prices can widen gradually, rather than collapsing suddenly. Institutions can adapt by developing new mechanisms to manage delivery requests and maintain the appearance of adequate supply. But the fundamental mathematics remain unchanged. A market structure built on fractional reserves will eventually face a moment when the fraction becomes insufficient. When that moment arrives, the price required to obtain physical metal will bear little relationship to the price quoted for paper contracts. The investors who recognize this reality are not preparing for a possibility. They are preparing for a certainty whose timing remains unknown, but whose outcome is structurally determined by the incentives and constraints that govern the system. The question is not whether the divergence will resolve, but how it will resolve and which institutions will survive the resolution. The resolution of structural imbalances in commodity markets follows a pattern that has repeated across centuries with remarkable consistency. The sequence begins with confidence, proceeds through denial, accelerates into panic, and concludes with restructuring that inevitably creates the conditions for the next cycle. What distinguishes the current situation in precious metals from previous episodes is not the pattern itself, but the number of simultaneous pressures converging on a system that has never been tested at this scale. The Chinese export restrictions represent one pressure. The institutional drawdown of exchange inventories represents another. But beneath these visible events lies a third factor that receives less attention and poses a more fundamental threat to the existing structure. Industrial demand for silver has reached levels that cannot be satisfied by current production, even under normal market conditions. The solar panel industry alone consumed over 200 million ounces of silver in 2024. This figure represented an increase of 30% over the previous year and reflects the aggressive expansion of renewable energy capacity in China, Europe, and the United States. Each photovoltaic cell requires a precise amount of silver paste to conduct electricity from the silicon wafer to to the external circuit. Engineers have worked for decades to reduce the amount of silver required per panel, and they have succeeded in cutting consumption per watt by more than half since 2010. But the total number of panels being produced has increased faster than the efficiency gains, resulting in absolute growth in silver consumption despite technological progress. The industry currently projects that annual installations will double again by 2030, which implies silver demand from solar alone could exceed 400 million ounces within 5 years. Electric vehicles present a similar trajectory. The average internal combustion vehicle contains approximately 15 grams of silver in its electrical systems. The average electric vehicle contains between 25 and 50 grams, depending on battery size and electronic complexity. As global auto production shifts toward electrification, the incremental silver demand is measured in tens of millions of ounces annually. The transition is not optional for manufacturers. Regulatory requirements in Europe, California, and China mandate increasing percentages of zero-emission vehicle sales each year. Automakers are investing hundreds of billions of dollars in battery factories and electric platforms. This investment commits the industry to silver consumption at levels that far exceed historical norms. The metal is not a discretionary input that can be eliminated through substitution. It is embedded in the fundamental architecture of the technology. Electronics manufacturing adds another layer of structural demand. Every smartphone, computer, appliance, and industrial control system contains silver in switches, contacts, and circuit boards. The quantities per unit are small, often measured in milligrams, but the global production volumes are enormous. Over 1 billion smartphones are manufactured annually. Hundreds of millions of laptops, tablets, and other devices add to this total. The silver in these products is not recovered when the devices are discarded. Recycling rates for electronics remain below 20% globally, and the processes for extracting silver from complex assemblies are energy-intensive and economically marginal at current prices. The result is a one-way flow of silver from mines and refineries into products that effectively remove the metal from the available supply permanently. Military and aerospace applications constitute a fourth category of demand that is both growing and completely inelastic. Silver's thermal and electrical conductivity properties make it irreplaceable in certain high-performance applications. Missile guidance systems, radar installations, satellite components, and aircraft electrical systems all specify silver where inferior conductivity would compromise performance or reliability. Defense procurement operates under different constraints than commercial markets. Cost is a consideration, but not the primary one. When a weapon system is designed around specific materials, substitution requires years of testing and qualification. The quantities involved in defense applications are smaller than solar or automotive demand, but the willingness to pay is effectively unlimited. A military buyer will pay $100 per ounce or $500 per ounce if that is the price required to secure supply for critical systems. When these demand streams are aggregated, the total industrial consumption of silver exceeds 800 million ounces annually. Global mine production in 2024 was approximately 820 million ounces. This suggests a market in approximate balance, with minor deficits covered by recycling and inventory drawdowns. But this apparent balance is deceptive for two reasons. First, mine production is not growing. The major silver-producing regions have been mined for decades, and the easy deposits have been exhausted. New discoveries are rare, and the deposits being found are lower grade and more expensive to process. The economics of primary silver mining are marginal at $70 per ounce. Most silver is produced as a byproduct of copper, lead, and zinc mining. When base metal prices fall, or when environmental regulations increase costs, the silver output from these operations declines regardless of silver prices. Second, recycling cannot scale to fill the gap. The silver in solar panels will not be recovered for 25 years. The silver in electric vehicles will not return to the market for a decade or more. The silver in electronics is dispersed in such small quantities across billions of devices that collection and processing costs exceed the value of the recovered metal at current prices. The structural deficit implied by these numbers is not a temporary phenomenon that will resolve through normal market adjustments. It is a consequence of technological choices made over the past 2 decades that locked in silver consumption at levels that exceed sustainable supply. The transition to renewable energy was adopted as policy by governments around the world without adequate consideration of the material inputs required. The shift to electric vehicles was mandated through regulation without securing the supply chains for the critical minerals involved. The proliferation of electronics was driven by consumer demand and commercial innovation without mechanisms to ensure material recovery. Each of these trends individually would create pressure on silver markets. Together, they create a demand profile that cannot be satisfied by available supply at prices that the industrial users can afford to pay. The divergence between industrial demand and investment demand creates additional complexity. When silver traded at $15 per ounce in 2019, industrial users could afford to maintain comfortable inventory levels and plan production without concern for material costs. At $70 per ounce, silver represents a significant cost component in solar panel manufacturing and creates pressure to reduce usage or find substitutes. But the substitutes do not exist at the required performance levels, and the reduction in usage per unit cannot keep pace with the growth in total units being produced. Industrial buyers are therefore forced to secure supply at prices they consider unsustainable, while simultaneously searching for alternatives that may not materialize for years. This creates a contradiction in the market. Industrial demand is price inelastic in the short term because production commitments have been made and contracts must be fulfilled. But it is price elastic in the long term because sustained high prices will eventually force design changes and substitution. The problem is that the long term may be 5 to 10 years away, and the market must clear in the present. Investment demand operates under entirely different logic. Investors buy silver not because they need it for manufacturing, but because they believe it will appreciate in value, or because they seek protection against currency debasement. Investment demand is extremely price elastic in the short term. When prices rise, speculative buyers rush in, hoping to profit from momentum. When prices fall, they liquidate positions to cut losses. But investment demand can also be structurally persistent, if driven by fundamental concerns about monetary stability rather than short-term price movements. The institutional drawdown observed in early January was not speculative. JP Morgan and Citigroup were not attempting to profit from a temporary price swing. They were repositioning for a structural change in the market, where physical possession would become more valuable than paper claims. This type of investment demand is price inelastic. The institutions involved will pay $70 or $90 or $120 per ounce because the alternative is being caught without physical inventory when the paper market breaks. The interaction between inelastic industrial demand and inelastic investment demand creates a market structure prone to violent price movements. In a normal commodity market, rising prices reduce demand and increase supply, bringing the market back into balance. In the current silver market, rising prices do not reduce industrial demand because the metal is embedded in technologies that cannot quickly adjust. Rising prices do not increase supply because mine production cannot expand quickly and recycling cannot scale. And rising prices may actually increase investment demand if the price increases are interpreted as confirmation that the supply shortage is real. This creates a positive feedback loop where scarcity drives prices higher. Higher prices attract investment demand. Investment demand further depletes available inventory, and reduced inventory drives prices even higher. The historical precedent most relevant to this dynamic is not the Hunt brothers' attempted corner in 1980, but the palladium market in the early 2000s. Palladium is used primarily in automotive catalytic converters, and its supply comes overwhelmingly from two sources, Russia and South Africa. In the late 1990s, Russian exports declined due to depletion of stockpiles accumulated during the Soviet era. At the same time, tighter emission standards increased palladium demand in catalytic converters. The result was a sustained deficit where industrial consumption exceeded production by millions of ounces annually. The price rose from $150 per ounce in 1999 to over $1,000 per ounce in 2001. Automakers were forced to pay these prices because they had no alternative that met regulatory requirements. Eventually, engineers developed catalysts using platinum as a substitute, and the palladium price collapsed. But the substitution took years to implement, and during that period, the market experienced extreme volatility and chronic shortages. Silver faces a similar dynamic with one critical difference. Palladium is used almost exclusively in one industry, automotive manufacturing. Silver is used across dozens of industries in applications ranging from solar panels to medical devices to water purification. The diversity of demand makes substitution more difficult because solutions must be developed independently for each application. A substitute for silver in solar panels does not help manufacturers of electric vehicle components. An alternative for electronics does not reduce demand from the photography industry or from manufacturers of mirrors and glass coatings. The market must solve multiple substitution problems simultaneously, each requiring years of research and testing, while industrial demand continues to grow across all applications. The Chinese export restrictions accelerate this timeline by fragmenting the global market into regional blocks that cannot easily arbitrage price differences. Under normal conditions, if silver becomes scarce in New York, buyers can source metal from London, Zurich, or Shanghai. The global market provides depth and liquidity that prevents regional shortages from causing extreme price dislocations. But when the largest producing nation restricts exports, the arbitrage mechanism breaks. Western buyers cannot access Chinese supply regardless of price. They must compete for the limited metal available in their own region, and that competition drives premiums far above the official spot price. The $89 retail price at APMEX, while the exchange trades at $71, is not an anomaly. It is the market revealing that physical metal in the United States is worth significantly more than the paper contracts traded in New York suggest. This bifurcation cannot persist indefinitely without resolution. Either the paper price must rise to match the physical premium, or the physical premium must fall to match the paper price. The latter would require a surge in available supply or a collapse in demand, neither of which appears likely given current fundamentals. The former requires a repricing of futures contracts to reflect the actual scarcity of deliverable metal. This repricing could occur gradually through a sustained upward drift in futures prices, or it could occur abruptly through a delivery default that forces the exchange to settle contracts in cash rather than metal. The precedent from the palladium market suggests that extreme scarcity can persist for years before substitution reduces demand. The precedent from the gold market in the 1970s suggests that once confidence in paper claims is lost, the repricing can be violent and can overshoot fundamental value by substantial margins. The institutions positioning themselves in early January understand these dynamics. They are not attempting to predict the exact timing of the repricing. They are ensuring that when it occurs, they hold physical assets rather than paper liabilities. Deutsche Bank's forced delivery of 3 million ounces to JP Morgan was not a voluntary transaction. It was the result of a calculation by JP Morgan that the risk of holding paper short positions exceeded the cost of acquiring physical metal at current prices. This calculation implies that JP Morgan expects either a significant price increase or a breakdown in the delivery mechanism that would make paper contracts worthless. In either scenario, physical possession provides protection. Paper claims provide only exposure to counterparty risk. The broader implication of this institutional behavior extends beyond the silver market to the foundation of the financial system itself. When the largest banks in the world stop trusting paper contracts and demand physical settlement, they are signaling a loss of confidence in the mechanisms that underpin modern finance. Every futures contract, every derivative, every exchange-traded fund is ultimately a promise to deliver something at a specified price. These promises work when all parties trust that delivery will occur as specified. When trust erodes, when institutions demand physical settlement rather than accepting cash equivalents, the entire structure of leveraged finance comes into question. The silver market is small enough that its disruption will not by itself threaten systemic stability. But the precedent it sets and the questions it raises about other markets and other assets have implications that extend far beyond a single commodity. The system built over 50 years on the assumption that paper and physical are equivalent is discovering that in moments of stress they are not equivalent at all. And once that discovery is made, it cannot be unmade through reassurances or policy statements. It can only be addressed through structural reforms that restore the credibility of paper claims by ensuring they are actually backed by deliverable assets. Whether such reforms will occur before the system faces a broader crisis of confidence remains the defining question of the current era.